I just want to get your take on the comments from Waller. Did you believe it was dovish? What's your outlook when it comes to cuts for this year? Do you believe 6 is still possible?
First, I would say Waller's comments were straight down the middle, and I think you'll hear more of them. I would not call them dovish. I think I'd call them a reflection of where he is in this whole process. In terms of the number of cuts this year, I think more likely 2 to 3, consistent with what they last said in their so-called dot plots. I think the market is disconnected from current Fed thinking.
You're the third person today to say they believe it's going to be 2 or 3. Give me a sense. Why is the market so disconnected from what the Fed is signaling and telling us all? And do you believe, is there a possibility that there could be no rate cuts this year at all?
I think it's unlikely to be no rate cuts this year because inflation does seem to be on a downward trend. And it's possible that things could weaken further. And so I think even with a normal Fed policy move, they don't want real rates to get into more restrictive territory. So as inflation comes down, rates, I think, do have to come down somewhat with them. Why is there the disconnect? I think Fed officials are focused on what they think of as risk management. They want to avoid the big mistakes they've made in the past, which have primarily been, sort of stop-start, fighting inflation, taking your foot off the brake. Inflation picks up again, and there they are having to speed up. So I think their natural inclination is to move more slowly. Markets, I think, are listening to the Fed to some degree, but saying, well, in the last year and a half, the Fed has often been wrong about what actually was going to happen. And so, why should markets put a great deal of weight on what they say? Let's watch and see what actually, unfolds. And so I think, you have two different forces at work here, with the Fed being focused on history and avoiding some mistakes, and the market, I think, being focused on their expectations.
Waller alluded to that in his comments, avoiding some mistakes from the past. I want to get back to the odds of a rate cut. So the markets are trimming those odds that we're going to see a cut at the March meeting from a 61% chance of a quarter-point move. That's down from roughly just about 65% a week ago. So we talked about the disconnect, but do you think very slowly the bulls, as we said in our teas, are moving to the sidelines, and some more, I guess, rational people that are actually listening to the Fed, are they kind of just tempering our expectations now?
I think they are. I think the market and the Fed will gradually get back into sync. Obviously March will come, and I think the talk for the rest of this week and before they go into blackout period will be very much around pushing back on this scenario that exists in the markets. At the end of the day, the data will prove it. But I would say yes. I would expect the expectations of March will start to recede from the market.
One other thing that Waller commented on is that he anticipates the Fed slowing its pace of quantitative easing. Currently, the central bank letting about $95 billion roll off its balance sheet every month. Your take on those comments?
I think he's reflecting the consensus of the view that this so-called quantitative tightening will continue. It was interesting to hear Lori Logan, who is perhaps the most experienced voice in this, the other day, maybe express some need to slow that down. So I think that is actually more of a debate at the table right now than the pace of cuts. It's really the pace of the so-called quantitative tightening and allowing the balance sheet to shrink.